People often ask me how Renaissance technologies achieved the returns we did. They want to know the secret formula, the magic algorithm, the one insight that made everything work. The truth is, there was no single breakthrough. There was no eureka moment. What we built was a system, a methodology, a way of thinking about markets that was fundamentally different from everyone else. And yes, algorithms were at the center of it, but not in the way most people imagine. Let me start by explaining what I mean by algorithms in the context of what we do. Most people hear that word and think of some complex mathematical formula that predicts stock prices. That's not quite right. Our algorithms weren't fortune-telling machines. They were pattern recognition systems. They were statistical tools for extracting signal from noise. They were frameworks for making thousands of small decisions systematically rather than a few large decisions intuitively. The foundation of everything we built was a simple observation that markets generate data, enormous amounts of data. Price movements, volume, volatility, correlations across securities, patterns across time scales. This data contains information, not the kind of information Wall Street looks for, not narratives about why companies will succeed or which sectors will outperform, but mathematical relationships, statistical regularities, patterns that repeat with measurable frequency. My background as a mathematician led me to approach this data differently than traditional investors. I didn't look at a stock chart and think about what it meant for the company's future. I looked at price series as sequences of numbers that might contain exploitable patterns. I didn't care why patterns existed. I cared whether they existed with statistical significance and whether they persisted when tested on data the models hadn't seen. That last point is crucial. In mathematics and physics, you develop theories and test them against data. If a theory fits historical data but fails on new data, it's not a valid theory. It's curve fitting, it's finding patterns in randomness that don't actually exist. The same principle applies to financial markets. You can always find patterns in historical price data. The question is whether those patterns have predictive power going forward. Our entire approach was built on rigorous testing to distinguish real patterns from statistical noise. This required several things. First, enormous amounts of data. We collected price data going back decades, not just daily prices, but intraday data at increasingly fine timescales. We gathered data on thousands of securities across multiple markets. The more data you have, the better you can test whether patterns are genuine or spurious. Second, sophisticated statistical methods. We used techniques from signal processing, from machine learning before it was called that, from information theory, from statistical physics. We were looking for tiny correlations that traditional analysis would never detect. These methods required serious computational power. In the 1,980 seconds and 1,990 seconds, we were investing heavily in computing infrastructure when most hedge funds were still using spreadsheets. Third, and most importantly, we needed a culture of empiricism. No preconceptions about what should work, no attachment to theories, just relentless testing of hypotheses. If something worked in the data, we used it. If it didn't, we discarded it. No exceptions. Let me give you a concrete example of how this worked in practice. Early on, we noticed that certain price patterns had predictive value for very short time horizons. Not days or weeks, but hours or minutes. These patterns didn't make intuitive sense. There was no obvious economic explanation for why they existed, but they showed up consistently in the data with statistical significance. A traditional trader would have dismissed these patterns. They'd say, "That doesn't make sense. There's no reason why that relationship should hold." We didn't care whether it made sense. We cared whether it worked. So we built algorithms to exploit these patterns. The algorithms would monitor thousands of securities simultaneously, looking for the specific conditions where our statistical models predicted short-term price movements. When conditions aligned, the algorithms would execute trades automatically. No human judgment, no discretion, just systematic execution based on statistical signals. Now, each individual trade had only a slight expected edge, maybe 51% probability of profit instead of 50%. That doesn't sound like much. But when you make thousands of trades and use appropriate leverage and manage risk carefully, those small edges compound into substantial returns. This is fundamentally different from how traditional investors operate. They're looking for big insights. They want to identify the next Amazon or predict the next recession. They're making a few large bets based on analysis and judgment. We were making millions of small bets based on statistics and algorithms. The advantage of our approach is consistency and scalability. Traditional investing depends on being right about major calls. You need to correctly predict big market moves or identify companies that will dramatically outperform. That's very difficult to do consistently. Our approach didn't require being right about anything major. We just needed our statistical models to have slight predictive power across many situations. As long as the aggregate edge persisted, we'd generate returns regardless of whether markets went up or down or sideways. The algorithms were essential to this approach for several reasons. First, speed. Many of the patterns we exploited existed at timescales where human traders couldn't react fast enough. You need computers executing trades in milliseconds. Second, complexity. We were monitoring thousands of variables simultaneously across thousands of securities. No human could process that much information. Third, discipline. Algorithms don't get emotional. They don't second guess themselves. They don't override signals because something feels wrong. They execute exactly what the models tell them to do. That last point is more important than people realize. The biggest challenge in systematic trading isn't building the models. It's having the discipline to follow them completely. If you start overriding your algorithms with human judgment, you destroy the whole system. The models work because they're systematic and unemotional. The moment you inject human discretion, you've lost your edge. This is why we only hired mathematicians and scientists. They understood that the algorithms were the system. Their job wasn't to make trading decisions. It was to improve the algorithms, to find new patterns, to refine the statistical methods. But once the algorithms were running, nobody second-guessed them. Now let me talk about how we developed these algorithms. It wasn't a one-time process. It was continuous research. We had dozens of PhDs constantly testing new hypotheses. They'd propose potential signals, maybe a particular combination of price and volume patterns, maybe a correlation between different securities, maybe a relationship involving macroeconomic data. Whatever the hypothesis, it went through rigorous testing. We'd look at historical data to see if the pattern existed. We'd test it on different time periods to ensure it wasn't specific to particular market conditions. We'd test it on different securities to ensure it wasn't just a quirk of certain stocks. Most importantly, we'd test it on out-of-sample data that hadn't been used to develop the signal. This last test was crucial. It's easy to find patterns in data you're examining. It's much harder to find patterns that persist on new data. Only signals that passed all these tests made it into our production algorithms. Even then, we monitored them continuously. Markets evolve. Patterns that worked in the 1,990 seconds might stop working in the 2000s. We had systems to detect when signals degraded and remove them from our models. This process required enormous computational resources. We were running thousands of statistical tests continuously. We were simulating trading strategies on historical data. We were optimizing portfolio construction algorithms. All of this needed serious computing power. In the early days, we built our own computing infrastructure. We hired computer scientists and engineers to design systems specifically for our needs. We were probably running some of the most sophisticated computational finance infrastructure in the world. As our models became more sophisticated, so did our algorithms. We started incorporating machine learning techniques. Not the deep learning that's popular now, but earlier methods like hidden Markov models and various pattern recognition algorithms. These methods could detect nonlinear relationships in data that traditional statistical approaches would miss. We also developed sophisticated risk management algorithms. This is something people often overlook when they think about algorithmic trading. It's not enough to find profitable patterns. You need to manage risk carefully, because even good signals sometimes generate losses. Our risk algorithms monitored portfolio exposure in real time. They ensured we weren't over-concentrated in any particular position or sector. They calculated value at risk under various scenarios. They adjusted position sizes based on volatility and correlation patterns. All of this happened automatically, implemented in algorithms that ran continuously. The result was a portfolio that was constantly rebalancing, constantly adjusting to changing market conditions, always maintaining appropriate risk levels. Let me address a common misconception. People sometimes think algorithmic trading is about high-frequency trading, that you're just front-running other investors or exploiting tiny price discrepancies that exist for milliseconds. That's not what we did. Yes, we traded frequently, and speed mattered. But our edge wasn't in being microseconds faster than others. Our edge was in having better statistical models. We were finding patterns that others couldn't detect because they weren't using the same analytical methods. Some of our signals worked at very short timescales. Others worked over hours or days. We operated across multiple time horizons simultaneously. The algorithms integrated signals from all these different timescales into unified trading decisions. This multi-timescale approach was important because different patterns dominated at different frequencies. Some inefficiencies existed in high-frequency data. Others showed up in daily or weekly patterns. By combining signals across timescales, we had more robust and consistent returns. Another key aspect of our algorithms was portfolio construction. It's not enough to know that security A is likely to go up and security B is likely to go down. You need to determine optimal position sizes considering your edge, the volatility of each position, the correlation between positions, and your overall risk constraints. We developed sophisticated portfolio optimization algorithms based on mean variance optimization and various extensions of modern portfolio theory. These algorithms would take our expected returns for thousands of securities and construct a portfolio that maximized risk-adjusted returns subject to various constraints. This portfolio construction ran continuously. As new signals came in, as prices changed, as volatilities and correlations shifted, the algorithms would rebalance the portfolio. Sometimes this meant making hundreds or thousands of trades per day. The algorithms handled all of it automatically. Now let me talk about something that's harder to quantify but was equally important. The feedback loop between our research and our trading. As our algorithms traded, they generated new data. We could observe which signals were working and which weren't. We could see which market conditions were favorable and which were challenging. This real-world performance data fed back into our research. Researchers could use it to refine models, to test new hypotheses, to identify when patterns were degrading. This created a virtuous cycle. Better algorithms generated better returns and better data. Better data enabled better research produced better algorithms. Over decades, this compounding of knowledge and methodology gave us an enormous advantage. We weren't just running static algorithms. We were running a constantly evolving system that learned and adapted. Let me give you a sense of scale. By the 2000s, our algorithms were processing terabytes of data daily. They were monitoring tens of thousands of securities across dozens of markets globally. They were incorporating thousands of individual signals into trading decisions. They were executing tens of thousands of trades per day. All of this happened automatically, with minimal human intervention. Our traders weren't making decisions about what to buy or sell. They were monitoring the systems to ensure everything ran smoothly. The actual trading decisions came entirely from the algorithms. This level of automation was unheard of in finance at the time. Most hedge funds were still doing discretionary trading where portfolio managers made decisions based on their analysis and judgment. We had completely eliminated human judgment from the trading process. That's not to say humans weren't important. They were essential. But their role was in research and system development, not in trading execution. This brings me to an important point about the limitations of algorithms. Algorithms are only as good as the models they implement and the data they process. If your underlying models are flawed, automating them just means you'll lose money systematically instead of haphazardly. This is why we were fanatical about testing and validation. We had multiple layers of checks to ensure signals were genuine before they went into production. We had systems monitoring algorithm performance to catch degradation early. We had researchers constantly working to improve models. The algorithms were the execution layer, but they sat on top of an enormous foundation of research, testing, and validation. That foundation was what really mattered. Let me also address what happened when things went wrong, because they did go wrong sometimes. Even with extensive testing, sometimes signals would stop working. Sometimes market conditions would change in ways our models hadn't anticipated. Sometimes we'd discover bugs in our code that caused algorithms to behave unexpectedly. When these things happened, we had protocols. We'd investigate immediately to understand what went wrong. We'd determine whether it was a temporary anomaly or a fundamental breakdown. We'd make corrections and improvements. The key was treating failures as data. When an algorithm didn't perform as expected, that told us something about our models or our understanding of markets. We'd learn from it and improve the system. This scientific approach to failure was crucial. Traditional traders often rationalize losses or blame external factors. We treated every failure as an opportunity to improve our algorithms. Over time, this led to increasingly robust systems. Now let me talk about returns. The results of this algorithmic approach speak for themselves. The Medallion Fund, which implemented these methods, generated average annual returns around 66% before fees for 3 decades. That's extraordinary by any measure. More importantly, those returns were remarkably consistent. We made money in bull markets and bear markets. During the 2008 financial crisis, when most hedge funds collapsed, our algorithms kept working. We returned 98% that year. This consistency came from the nature of algorithmic trading. We weren't dependent on particular market conditions. We were exploiting statistical patterns that existed across different environments. Our algorithms adapted automatically to changing conditions. Some signals would work better in volatile markets. Others worked better in calm markets. The system balanced across all of them. People often ask whether our success means markets are inefficient. That's not quite the right way to think about it. Markets are mostly efficient in the sense that it's difficult to consistently generate excess returns, but mostly efficient isn't the same as perfectly efficient. There are tiny inefficiencies, small patterns, statistical regularities that persist because they're too subtle for most participants to detect or exploit. Our algorithms were designed to find and exploit exactly those tiny inefficiencies. Each one was small, but across thousands of them, aggregated systematically, They generated substantial returns. Another question people ask is whether our algorithms could work for individual investors. The honest answer is no, not really. What we did required enormous resources. The data infrastructure alone cost millions. The computing systems cost millions more. The team of PhDs cost tens of millions annually. Individual investors can't replicate that infrastructure. They can't access the data at the quality and frequency we used. They can't implement the sophisticated statistical methods we developed. More fundamentally, most of the patterns we exploited existed at timescales or in market microstructure that individual investors can't access. You can't execute thousands of trades per day from your brokerage account. The transaction costs would destroy any edge. That said, the principles behind what we did are applicable to any systematic approach to investing. Use data, not intuition. Test rigorously. Be disciplined in execution. Manage risk mathematically. Don't let emotions drive decisions. Those principles work at any scale. You don't need algorithms executing thousands of trades, but you do need a systematic process and the discipline to follow it. Now let me talk about how algorithmic trading has evolved since we started. When we began in the 1,980 seconds, we were pioneers. Almost nobody else was approaching markets this way. Now, algorithmic trading is common. High-frequency trading firms have taken some of the methods we developed and pushed them further. Machine learning has become standard. The amount of computing power applied to markets has grown exponentially. This means some of the patterns we exploited decades ago no longer exist. Markets have become more efficient in certain ways as more participants use sophisticated algorithms. But new patterns emerge. Markets evolve and create new inefficiencies. The arms race continues. This evolution validates our approach. The fact that algorithmic methods have become standard in finance proves that they work. The fact that new patterns keep emerging shows that perfect efficiency is impossible. Markets are complex adaptive systems. There will always be patterns to find for those with the right tools and methods. Let me close by reflecting on what algorithms really gave us. Yes, they generated extraordinary returns, but more fundamentally, they allowed us to think about markets in a completely different way. Instead of trying to predict the future or understand causation, we focused on measuring patterns and exploiting correlations. Instead of making big bets based on conviction, we made countless small bets based on statistics. Instead of trusting human judgment, we trusted empirical evidence and systematic execution. This paradigm shift was only possible through algorithms. You can't implement this approach manually. You need computers executing strategies systematically, processing enormous amounts of data, making decisions without emotion or hesitation. The algorithms weren't just tools. They were the manifestation of a completely different philosophy about how to approach financial markets, a philosophy grounded in mathematics, statistics, and empiricism rather than intuition, experience, and narrative. That philosophical shift, implemented through algorithms, is how I built my fortune. Not through any single brilliant insight, but through decades of systematic research, rigorous testing, and disciplined execution, all enabled by increasingly sophisticated algorithms that could do what human traders never could. The lesson isn't that everyone should become an algorithmic trader. It's that systematic, empirical approaches to problems often beat intuitive, experience-based approaches. That data analyzed rigorously reveals patterns invisible to casual observation. That automation and discipline trump discretion and emotion. Those principles apply far beyond finance. They're how progress happens in any field. Algorithms were just the tool that let us apply those principles to markets, and they work spectacularly well.